Welcome back to Daily Forex. In today's videos, we're going to be taking a look at what Forex spreads are and how they work. So let's look at Forex trading and how Forex works. The vast majority of Forex brokers will advertise in very big letters somewhere on their site that they do not charge commission. With the exception of a few brokers, the Forex market lets traders open and close positions with no commission at all. So how do these Forex brokers make money? Well, it costs you nothing to trade. This of course begs the question, the obvious one, how do Forex brokers make money? Here's where it can get tricky. It is true that there are brokerages who charge no commission to Forex trading. But the brokers are also not trading for you out of the goodness of their hearts. You can be sure that they can come out on top, and in a big way. They charge you what's referred to as Forex Spreads. The brokerages with lower spreads often do charge commissions in addition to the spreads. It is so important to understand all costs related to your trades before making major decisions. Before we understand what Forex spreads are and how they're calculated, it is important to understand one major principle about how the Forex market works. It is all based on supply and demand, just like any other market. If there is a higher demand for dollars, the value of the dollar will go up versus other currencies. This is precisely how Forex spreads are defined and calculated. Forex spreads. A Forex spread is the difference in price between what a Forex broker will buy the currency from you for and the price at which they will sell it. So, for example, if you are opening a position in which the base currency is dollars, and since there is no shortage in demand for dollars, the Forex spread on this transaction will almost always be smaller than a spread on a less common currency. Why? This is again because of supply and demand. The broker will have no problem whatsoever selling of the dollars they just bought. So, they do not need to charge you, the trader, a higher spread. Whereas if the position's base currency was in, say, Vietnamese dong, the spreads would typically be higher. It means the broker is taking a bigger risk, and as a result, they charge more for that risk. Because of this, it is recommended for the individual trader to avoid buying or selling currencies with lower demand. It will cost much more because of the higher spread. If a broker were to buy and sell currencies with no change in the exchange rate, the trader would lose money because the sell, the ask price, is always higher than the buy, the bid price, enabling the broker to always make money on the transaction. On a small scale, you see this if you exchange money at a bank when you travel. They will always offer more when they buy your dollars than when they sell them back to you. Now, another characteristic Forex brokers take into account when calculating spreads is the type of account in which you're trading. Mini accounts are typically associated with higher spreads. This is of course because the broker needs to compensate the relatively low amount of capital being traded with a higher spread, so as to make their profit. A mini account might be trading in the tens of thousands of currency units, whereas most Forex trades are closer to 1 million units. This means that if the spread is 0.0004 or 4 pips, it can cost the average Forex trader £400 or dollars, whatever currency they are trading in. It is extremely crucial that traders understand how significant the spread is when choosing a broker. The difference one single Forex pip can make in a broker spread might be the difference between a successful Forex trader and a complete Forex failure. A pip is defined as the 4th digit after the decimal. Just to summarise, let's take a look at a concrete example of a spread and understand how it works exactly. Let's say we had a dollar CAD, aka Loonie, bid price of 120.00. That is the price at which the broker is willing to buy the dollars. And an ask price of 120.05, the price at which the broker is willing to sell the dollars. In this case, the spread is equal to 0.05 or $0.0005 or 5 pips, and that money goes straight into the broker's pockets. There are charts readily available on the internet that enable you to see Forex spread commission. You can see where major brokerages lie compared to each other, showing different spreads or different currencies. Even fixed spreads change periodically, so it is very important to stay on top what your brokerage is charging. Many market makers charge a smaller spread during more common trading hours to encourage people to do more trading when there is more demand. There is much more to be said about Forex trading spreads, such as whether a broker offers fixed or variable spreads, and which is better for the trader. Fixed spreads are always higher than variable spreads because they include some form of insurance. Be aware that often brokers who offer fixed spreads restrict trades during news announcements when the Forex market is particularly volatile. Thus, the insurance really doesn't help you. You should now have a better understanding on how Forex brokers make their money and how to make more educated decisions about Forex trading strategies. Don't think though that Forex brokers make their money by charging spreads and commissions. The clear majority of retail Forex brokers make their money by taking the other side of their clients' trades, most of whom lose their money, which goes straight into the broker's pockets. It is important not to be naive about this, but you don't have to believe that your broker is out to get you or cheat you either. So we hope that gave you a good insight into Forex brokers and their spreads. Thank you again from Daily Forex. Do not forget, for all the latest market analysis and educational videos, do not forget to download the Daily Forex app.